Welcome to a deep dive.
Hi there.
We're digging into the latest earnings call from nCino today. That's the cloud software company focused on financial institutions.
Yeah, banks, credit unions, that kind of thing.
Exactly. So we've gone through the materials, the call, the slides, and our mission here is basically to give you the highlights, the key takeaways.
Your shortcut to understanding what's happening with them right now without you having to wade through it all.
Let's jump in, maybe start with the core problem they're trying to solve.
Yeah, absolutely. At its heart, nCino is all about tackling the headaches financial institutions face with their older technology.
The legacy stuff.
Right. You've got fragmented systems, data stuck in different places. It just slows everything down. Decision-making, using data properly, adopting AI.
Hinders growth, costs more money.
Exactly. It's a real drag on their business.
So nCino comes in with this unified, cloud-based platform. What does it cover?
Things like lending, onboarding new customers, opening accounts, managing loan portfolios, pretty much the core operations.
And it's all powered by AI.
That's the pitch. They see themselves as being the main system, the system of record for these critical operations. And they're already deployed in, over 20 countries?
Yeah, something like that. Diverse customer base, too.
And they really feel that being this central system gives them a strong competitive advantage. Moat, as they say.
Okay, so that's the big picture. Let's get into the numbers. Q1 of their fiscal 2026. How did they do?
Overall, a pretty solid start to their year. They came in ahead of what they'd guided for.
Okay. Top line.
Total revenues were $144.1 million. That's up 13% from the same quarter last year.
13%, nice. And ahead of guidance, you said.
Yep, beat their own expectations.
What about subscription revenues? That's usually key for these SaaS companies.
It is. That came in at $125.6 million. So that's up 14% year over year as reported.
14%.
Now, if you look at it organically, so stripping out the impact of recent acquisitions, that growth was 9%, still pretty healthy.
9% organic growth. Got it. And professional services. The implementation side.
That was $18.5 million, up 5% year over year. And that also beat expectations, partly due to some timing things with revenue recognition they mentioned.
Okay. How about international? You said they're in 20 plus countries.
Yeah, international is doing well. Total revenues outside the U.S. were $31.6 million. That's up a strong 22% year over year.
22%, wow.
Uh-huh. And if you look at it in constant currency, so ignoring the currency fluctuations, it was even a bit better, 23% growth. Non-U.S. subscription revenue was particularly strong.
Okay, so good revenue growth, both overall and internationally. How did that flow down to profits?
On the bottom line, they reported non-GAAP operating income of $24.8 million.
Non-GAAP, so adjusted for certain items.
Right. Gives you a cleaner look at the core operations. That $24.8 million works out to a 17% margin on their total revenue. And like the revenue, that also came in ahead of expectations.
Better revenue, better operating profit than guided.
Exactly. And that carried through to the non-GAAP net income, $18.4 million or 16 cents per diluted share.
16 cents a share. Okay. Anything else on the financial side for Q1? Capital allocation?
Yeah, they mentioned share repurchases. They bought back about 1.8 million shares during the quarter, spent just over $40 million on that.
So returning capital to shareholders.
Seems like that, along with integrating the companies they've bought previously, is the main focus for their capital right now.
Okay, so a solid Q1 performance. How's management framing this in the bigger picture?
They sounded, very encouraged. They see it as a really important step towards their bigger goal of being a, quote, great long-term business that executes precisely.
Precision. Okay.
And they're saying demand signals are building. They pointed to the reaction they got at their recent customer conference Insight, especially around their new AI stuff and the omni-channel experiences.
Insight seems like a pretty big event for them.
It really is. It's where they show off the new tech, get that direct feedback. And they mentioned that their internal KPIs, like new ACV bookings.
Annual contract value.
Right. That's tracking well. And ACV is important because it's a lead indicator for future subscription revenue. So good progress there suggests good momentum ahead.
What specifically did they roll out at Insight?
A fair bit, it sounds like. Enhancements to onboarding, creating those smoother digital experiences across channels, making their mortgage solution more scalable.
And embedding more AI, you said.
Yeah, embedding intelligence right into the workflows. They feel this delivers on promises, but also, crucially, opens up new ways to grow.
AI keeps coming up. It really does sound central to their strategy.
Oh, completely. They see it as core to their long-term differentiation. They believe their specific approach is uniquely powerful in fintech.
What's unique about it?
They talked about leveraging a large process-centric data set, basically data derived from how lending and banking operations actually work day to day.
Okay, so it's trained on real financial processes, not just generic data.
Exactly. And that lets them build more targeted AI tools. At Insight, they released 16 new capabilities for their AI tool, which is called Banking Advisor.
16 new ones on top of what they had.
Yeah, they already had 2 available. These new ones are all designed to help customers, save time, cut costs, improve productivity within those specific banking workflows.
And that drives growth how?
Well, it's seen as a key driver for future subscription revenue. Because Banking Advisor drives more usage of the platform overall, it makes the core platform stickier and more valuable.
Got it. So more embedded intelligence leads to more platform usage, leads to more revenue.
That's the idea.
Okay, so beyond the AI push and general platform improvements, where else are they seeing specific growth opportunities?
They highlighted a few areas. One is a big mortgage cross-sell opportunity.
Cross-selling mortgage solutions to existing customers.
Right. They gave an example, a $25 billion regional bank. It renewed its contract for 5 years, but also doubled its annual commitment by adding nCino's mortgage and consumer lending solution.
Coupled. Wow.
Yeah. The bank wanted a consistent experience for its customers across different loan types, all on the one platform. Another big focus is the credit union market. They see that as a $1 billion opportunity. SAM, they called it.
Serviceable addressable market, the potential slice they can capture.
Exactly. And they mentioned a deal with an $800 million credit union. It was already a customer, but expanded big time, adding consumer lending, including indirect auto, commercial lending, and account opening.
All onto the unified platform. Sounds like vendor consolidation again.
Precisely. Reducing complexity, consolidating vendors that addresses that core legacy tech problem we talked about.
Makes sense. What else?
International expansion, still core to the strategy, saw good progress in Q1, mentioned an add-on deal at a top Canadian bank, and interestingly, a new logo win in Japan.
Japan, so broadening beyond just Europe.
Seems so. They explicitly said they view the global opportunity broadly, not just the EME initiatives they'd focused on before. Sounded quite positive about Europe and Japan specifically.
Okay, so several growth levers. How is the broader market environment playing into this? Are banks actually spending?
Management acknowledged the macro picture is still, a bit fluid, but they are seeing encouraging signs.
Such as?
They said their customers, the banks and credit unions, are generally well-positioned, healthy balance sheets, projecting growth in loans and earnings. They also noted stability returning to the mortgage market, which actually helped their Q1 results.
Any other potential tailwinds?
They did mention the possibility of U.S. deregulation freeing up some capital for banks, which could then encourage more tech investment, like adopting nCino's platform.
So overall, they sound pretty confident, despite the macro noise.
Yeah, confident in their strategy, their products, their execution. They said customer conversations feel more focused, more strategic, and more forward-looking than even just a few months back. And digging in a bit, they said things like the positive buzz at Insight, steady interest across their solutions, and their pipeline tracking all point to robust underlying demand.
So banks are budgeting for this kind of tech investment.
That's what they're hearing. The need for efficiency is still strong, even with the macro uncertainty.
You mentioned credit unions specifically before. Did they talk more about that market?
Yeah, they did clarify. While the tech solution is similar to what banks need, the sales approach has to be different. You have to understand the credit union culture, the focus on serving members.
So a tailored approach.
Right. They've put leaders and teams in place with credit union backgrounds, and they're leveraging their existing footprint. They already have over 800 credit unions using one of their portfolio analytics tools, so they have an in.
Okay, that makes sense. Let's shift gears a bit. There was a restructuring announcement impacting about 7% of the workforce. What was the rationale there?
Yeah, that was a significant event. Management said, look, these weren't easy decisions, but they felt they were necessary. It came out of a deep review of their processes, their structure, how they build and deliver software.
And AI played a role in that review.
Apparently so. Leveraging AI tools was part of it. The main goals they stated were to streamline operations, cut bureaucracy, get more efficient, and ultimately get new product features out to market faster.
So efficiency, speed, shareholder value.
And delivering durable, accelerating growth, as they put it.
What's the financial impact of these changes?
They expect about $24 million in gross annualized expense savings from these actions, combined with other efficiency efforts.
24 million annualized. How does that compare to previous plans?
Well, their initial plan for fiscal 26 already had about $6 million in savings baked in. This restructuring accelerated things and added an additional $18 million on top of that.
An extra $18 million. That's substantial. How does that flow into the outlook for this year?
They're being a little cautious initially. They're only flowing through about $5 million of that extra $18 million into their updated non-GAAP operating income guidance for fiscal 26.
Only $5 million out of $18 million. Why hold back?
To preserve flexibility. They mentioned wanting the ability to potentially make more investments, particularly in AI tech if good opportunities pop up. The main benefit of the savings will hit more in the second half of the year anyway.
Okay. And where will these savings mostly show up? Which expense lines?
Primarily R&D. They feel major development cycles are complete so they can streamline there using AI. Also some benefit to cost of goods sold as they redesign products for faster implementation.
What about professional services margins?
They said those might take a bit longer to improve. They need to work through some older legacy projects first, but they are confident that AI and the redesigned products will boost efficiency there over time.
Got it. Okay, let's talk updated guidance then. What's the outlook for Q2 and the full year now?
All right, for Q2 fiscal 26. Total revenues expected between $142 million and $144 million. Subscription revenues between $124.5 million and $126.5 million.
Okay.
Non-GAAP operating income guided to $23.5 million to $24.5 million. And non-GAAP net income per share, 13 to 14 cents.
Why the slight dip in total revenue sequentially from Q1?
They pointed out they're not assuming the Q1 overperformance in mortgage and professional services carries into Q2. Plus, their big user conference, Insight, happens in Q2, which adds about $2.5 million to sales and marketing costs sequentially.
Right, the conference costs. Okay, what about the full fiscal year 26?
They reiterated their ACV target. They still expect to add $48 million to $51 million in new annual contract value this year on a constant currency basis.
Including acquisitions.
Yeah, that includes about $4.5 million from the Sandbox Banking acquisition they did. At the midpoint, that ACV target represents about 19% organic net ACV bookings growth.
19% ACV growth this year, and the idea is it fuels next year's growth.
Exactly. They expect that to accelerate subscription revenue growth specifically in fiscal 27.
Okay, so how did the strong Q1 subscription number affect the full year guidance for that line?
They flowed most of the Q1 beat through, but consistent with how they guide, they didn't flow through about $800,000. They considered seasonal overperformance in U.S. mortgage subscriptions from Q1.
So keeping it a bit conservative there. What's the new subscription guidance range?
Updated FY26 subscription revenue guidance is now $507 million to $511 million. That's up from $503 to $507 million previously.
And then what's the growth rate implied there?
At the midpoint, it's about 8.5% growth year over year. Organically, excluding currency, they now expect about 5% growth at the midpoint. That's up from the 4% organic growth they implied last quarter.
So organic subscription growth expectation ticked up slightly.
Yes. Though they did caution this guidance assumes Q4 has the lowest year-over-year growth, and they're not assuming any growth in U.S. mortgage subscriptions year-over-year in Q4. Inorganic contributions are unchanged.
Okay. Putting it all together, what's the updated total revenue guidance for the year?
Updated FY26 total revenue is now $578.5 million to $582.5 million. That's up from $574.5 million to $578.5 million before. Represents about 7% growth at the midpoint.
And the bottom line impact from the restructuring in Q1 beat.
Right. Fiscal 26 non-GAAP operating income is now expected to be $112 million to $116 million. That's up nicely from $107 to $111 million previously.
What kind of increase is that year over year?
At the midpoint, it's about a 19% increase over fiscal 25. Pretty significant leverage.
19% operating income growth.
Wow.
And earnings per share.
Updated FY26 non-GAAP net income per diluted share is now 69 to 72 cents, up from 66 to 69 cents.
Okay, and just to confirm, the restructuring didn't impact their plans to increase sales capacity.
Correct. They confirmed that the 14% increase in sales capacity they planned for FY26 was already in the initial guidance and remains unchanged.
Good to know. You mentioned product redesign for faster implementation. They talked quite a bit about deployment efficiency, didn't they?
They absolutely did. It was a key theme. They acknowledged that historically, their highly configurable platform, while a strength, often led to these really long consultative implementation projects, months, sometimes years.
And the market's appetite for that has changed.
Exactly. Less patience for those long, drawn-out projects. So nCino has consciously evolved. They're dialing back some configurability, delivering more out-of-the-box functionality.
To shorten those timelines.
Drastically. They have, frankly, bold goals, talking about taking projects from months or years down to just months or even days for some solutions.
That would be a game changer.
It really would. And they see it as a strategic investment. If they can remove that deployment friction, it could speed up sales cycles significantly, especially later this year. Customers see value much faster.
And it helps their own margins too, right?
Should do. Improves professional services gross margins over time as they rely less on custom work and more on AI and these faster to deploy products. Just a couple of other quick points from the Q&A. They touched on why they don't guide to billings. It's just too lumpy quarter to quarter, but nothing unusual there in Q1.
Okay.
And they discussed the ACV mix. Having a broad platform helps them weather trends affecting different banking areas. Said commercial lending pipeline look healthy.
What about the recent acquisitions? How are those integrating?
Sounded positive. DocFox is ready for U.S. community banks. Full Circle adding momentum in Europe. Allegro Key for credit union indirect auto. And Sandbox Banking, the most recent one, seems foundational for their AI data strategy and integrations. Really enabled some of the new AI stuff shown at Insight.
Sounds like Sandbox was a key piece.
Yeah, they seem pretty excited about its impact already.
Okay, wow. We covered a lot there. Strong Q1, strategic focus on AI and deployment speed, the restructuring for efficiency, and an updated raised outlook.
Yeah, it's a picture of a company performing well now, but also making some significant adjustments both operationally and technologically to set themselves up for faster, more efficient growth down the road.
Seems like they're feeling better about the market, hearing positive things from customers, while taking control of their own efficiency.
It'll definitely be interesting to see how that focus on deployment speed plays out. If they can really deliver on shrinking those implementation times, that could be a powerful accelerant.
So we've taken our deep dive into the nCino earnings call. Q1 performance, strategy, growth levers, the efficiency drive, and that updated outlook.
We've seen a company navigating the market, pushing hard on AI and specific opportunities like credit unions, while also making those internal changes with the restructuring.
Definitely. Okay, here's a final thought for you to chew on. nCino is betting heavily on AI, not just for features, but to fundamentally change how they operate and deliver software, aiming for that radical reduction in deployment time. So could the speed and efficiency of actually getting these sophisticated solutions up and running become the main way fintechs compete for financial institution clients going forward? Maybe even more critical than the specific features themselves.
Speed to value as the primary differentiator.
Something to consider as this market keeps evolving.